Today, we will talk about pros and cons of owning rental property. The main reasons people purchase rental property, as well as any other asset, is to make money and build wealth over the long term. As with any other market, housing prices and demand for rental property can fluctuate up and down, depending on the real estate market cycle. Residential rental properties come in all shapes and sizes, from single-family rental homes to condos and coupes, townhouses and mobile homes, small multifamily properties with 2 to 4 units, fractional ownership shares of a home, crowd funds, and REITs. 10 pros of owning rental property. 1. Diversification. One of the risks that investors can face is having all of their eggs in one basket, so to speak. Because it's easy to purchase stocks and bonds online, people may end up overweighted in traditional investments. Many investors use rental property as a strategy for diversifying their portfolios. 2. Less volatility. Volatility measures the amount of change in an asset price over a specific period of time. Most investors view low volatility as a good thing because prices and financial performance is more predictable over the long term. 3. Direct control. People who own rental property directly have complete control over their investment. For example, landlords are free to choose the best tenants, provided all applicants are treated fairly. Use the property as a short-term or long-term rental, and decide when and if the time is right to sell. 4. Rental income. The potential for recurring, monthly net income is another advantage to owning a rental property. Unlike the S&P 500, which has offered a dividend yield of 1.34%, September 2021, rental housing may offer significantly higher returns. Some of the rental properties listed for sale on the Roofstock Investment Property Marketplace offer annual returns of 5% or more. 5. Property appreciation. Home prices in the U.S. have historically increased over the long term. As the Federal Reserve reports, the median sale price of houses sold has increased by more than 52% over the past 15 years. However, during that time frame, home prices did go up and down. During the global financial crisis of 2007, 2009 housing prices dropped by about 20% and declined by nearly 5% between Q4 2017 and Q2 2020. 6. Tax benefits. Many beginning real estate investors are pleasantly surprised to learn just how friendly the tax code in the U.S. is to real estate investors. Some of the biggest rental property tax benefits include operating expense deductions from gross rental income, capital improvements added to property cost basis and recovered through depreciation, depreciation expense used to reduce pre-tax net income, owner deductions such as traveling to the rental property and tuition for continuing education, 20% pass-through tax deduction for qualified real estate investors. 7. Financing options. Residential rental property is generally easy to finance. Loan programs for investment real estate include conventional mortgages from banks and savings and loans, conforming loans backed by Fannie Mae and Freddie Mac, private lenders who invest in real estate debt instead of equity, and money raised for real estate partnerships. 8. House hacking. House hacking is a popular rental property investing strategy for people who may not have enough money for a down payment to purchase a rental property. 9. Exit strategies. Rental property owners have choices when the time comes to sell. People who own commercial property or even small apartment buildings end up selling to other investors. If the demand for the asset class is low, such as some office buildings or retail properties, buyers may be few and far between. 10. Tax-deferred exchange. Taxes on rental property work a little bit differently than a primary residence. For example, people selling a primary residence can qualify to exclude up to $250,000 of the gain from taxable income and up to $500,000 if married filing a joint return. 10 cons of owning rental property. 1. Capital and credit required. Most lenders offering loans for a rental property require a down payment of at least 25% of the purchase price. In addition to a large down payment amount, borrowers can expect to pay a higher interest rate than with a primary residence generally between 0.5% and 0.75% more. Investors are also expected to have a minimum credit score of 620 out of 850 and keep enough cash in reserve to cover up to 6 months of loan payments. 2. Tenants. Even with the best tenant screening process in place, it's possible for a landlord to end up with a problem tenant. Some tenants can't or won't pay the rent on time, or break the lease by damaging the property or doing something illegal. 3. Landlord responsibilities. Some investors decide to self-manage a rental property. Others choose to hire a good local property manager to take care of day-to-day details like tenant communication, rent collection, coordinating repairs with vendors, and complying with landlord-tenant laws and fair housing laws. 4. Property taxes. While there are plenty of things an investor can control with a rental property, two of the expenses that can be a challenge to predict are annual property taxes and the cost of insurance. For example, taxes on property vary widely from state to state and may significantly increase year over year due to the operating budget of the local government. In some states, property taxes readjust each time a home is sold, a fact that some investors overlook when putting together a profit and loss pro forma before purchasing the property. 5. Constant maintenance. Rental property requires constant maintenance and repairs to keep the home habitable and maintain the property value. Although some investors use the 50% rule to ballpark the operating expenses of a rental property, maintenance costs will vary from month to month. In fact, it's possible to have negative cash flow in a month where repair costs are unexpectedly high. 6. Neighborhood changes. The neighborhood a rental property is located in can change over time, which in turn affects the value of the property. As the CDC explains, when gentrification occurs, the transformation of neighborhoods goes from low value to high value. 7. Tax code changes. For the time being, the tax code is real estate investor friendly and has been for quite some time. But that doesn't mean that tax laws won't change. For example, the current administration has proposed raising the top capital gains tax rate from 20% to 39.6% for people making more than $1 million a year. 8. Lack of liquidity. Even in today's hottest real estate markets, homes can take 30 days or longer to sell. Investors who need to sell fast may end up selling a home for less than what the property is really worth. Depending on the property condition, a seller may also need to make a significant amount of repairs to find a buyer willing to pay a fair price. 9. Real estate market cycles. While home prices historically increase, the real estate market also moves through fairly predictable 18-year cycles, even if it doesn't seem that way today. 10. Profit isn't guaranteed. Owning a rental property isn't a guaranteed way of making money. Home prices can go down, operating expenses can be much higher than expected, and it can take much longer than expected to find a qualified tenant willing to pay a fair rent. Before you go, please hit the like button and subscribe to my channel.